All right. So today we'll be talking about business valuation.
Okay.
So today we'll be talking about business valuation, and it's just more of like I said, introductory, and it will take over on the calculations and all the questions solving aspect of it. So we'll just be discussing, and I will just we'll just discuss and see how far we can go about that. So let's start with that. Let's start with this business valuation. So what do you understand by business valuation? What's your view on business valuation, and what are the reasons for business valuation?
Hmm. Business
So
valuation
yeah.
is just to how they value business.
Okay. So when
What
we
did
when we
you
say okay, so when we value business, why do we value business? Okay, if we value business, what's the essence of valuing a business?
maybe possible M&A, merger and acquisition, or um, kind of knowing the market value of the is it either M&A or closing down a business or reconstruction.
Yeah. So that's basically what business valuation is all about. So business valuation method is we use it to determine the value of a private company. So for instance, for a management buyout, right? When there's a management buyout, we use it for valuing the business of a private company. Also, we also use it to determine the maximum price to acquire a listed company. So for instance, now for companies that are listed on the stock exchange, for us to get the right price to negotiate in consuming a transaction, we have to do evaluation. We have to do evaluation, and there are different types of methods to in valuing a company. Also to value, so for valuing, so when you want to join, also when you want to join a stock company, a stock market, for instance, IPO, initial public offerings, we use valuation in doing that. So for instance, now let's say, oh, I want to go quoted, I'm tired of I want to just be I want to be on stock exchange, so to have international presence and to be able to raise capital in the stock exchange market and debt, as the case may be. I might decide to go quoted as a private company. So for me to go quoted, we have to do an initial valuation. Okay, what does this business currently worth at the moment? And if at all the investors want to invest in this business in terms of minority shareholdings, what's the asking price or the willing price that we're able to sell at the market? So those are things that those are reasons for what for valuing companies. And also to we value subsidiaries, divisions for possible disposal or spin-off. So sometimes we might want to dispose a particular business line or business segment of a group, and we need to value that aspect, like for a possible disposal or spin-off, as the case may be. I want to ask a question. They usually say quoted share price are only relevant for minority shareholdings. Have you heard of that before? Do you have an idea of what that means?
No, I'm just hearing it for the first time.
Okay, so most times, so most most price you see of a company, right, or stock exchange are usually minority shareholdings. And when we talk about minority shareholdings, what do we mean by minority shareholdings? Minority shareholdings are shareholdings by small group of individuals like me and you now. When we buy shares on the stock exchange, right, those shares are minority shareholdings. For instance, now if I buy shares of maybe it's even 10 million units worth of shares of Access Bank or a GT or Fidelity Bank, it's less than 1%, it's less than 0.05 or less than 1% of the total outstanding shares of that company. That's a minority share. So most prices you see are minority shareholding prices. When we talk about majority shareholding prices, they are not those prices you see on the stock exchange. Because why? For you to have a major for you to have a major shareholding in a company, it means what? It's most likely you might have a bit of control in that business. And if you're going to have a bit of control, and when we talk about control, it means that you have the power to take key decisions on the to take key decisions in the operation of the business. So for instance, you have the power to influence whatever happens in the business. And when you have the power to influence whatever happens to the business, it means that we're not going to be selling that shares to you at a normal market price, right? But there's going to be a bit of what of premium to it. That's why we talk about control premium.
Yes.
So when we are doing evaluation, especially when for majority shareholders, right? On top of the normal price as it's quoted on the stock exchange, there's going to be a bit of what of premium in that we are going to include when we are. So for instance, now if we are selling to normal people at 5 naira per shares, by the time we are going to do your own valuation, we might be selling to you at 7 or 8 naira. So it means that 3 naira is what is the premium on it.
Okay.
So let's move on. Yeah, thank you. So for ACC examination, well, we might be looking at most of the valuation method, right? But there's only two distinct one that comes out in in um ACC, and it's mostly the DCF approach, the the dividend valuation method, and free cash flow. So basically, it's just free cash flow and dividend valuation method. Those are the methods you'll be seeing mostly in ACC. And for free cash flow, we have two types. We have free cash flow to equity and free cash flow to what to firm. Are you familiar with that?
Yes, I am.
Yeah. So there are various methods of valuing businesses which may produce very different results. And this can be used to determine a relevant range of prices. We have the minimum price the current owner is likely to accept, and the maximum price the bidder should be ready to pay. So that's the equilibrium price. Minimum price is the price at which we, the owners, are ready to accept, and the price at the maximum price which the bidder, those who wants to bid for the stake, is what is ready and prepared to pay for. So the final price will result from negotiation between the parties. What is the compromise we are all ready to take, right? Either from the seller or either from the bidder. So we have different the following method of valuation can be considered. We have what asset valuation. So we have the asset valuation basis, where the summary of the company assets less its liabilities are valued on some agreed basis. So when we're talking about asset valuation, so we just look at the total assets, we look at the liabilities like of the company. So your total asset are your PP, your goodwill, current asset, cash at hand, receivables, and the like. So we do the valuation of what those things currently worth, right? That's the valuation of your assets. And we also look at your liabilities. Your liabilities are your payables, your loans, debentures, and the likes, long-term debts, and all those and the likes. You look at those things, you do evaluation of that. We get the value of those things. The net amount is what that's the value of the company. Whatever is the net amount, and whatever is the net amount is just your equity, right? So
Okay.
it's just your equity. Your total asset less your liability is your equity. So that's the equity value of the company. So we also have relative valuation. Relative valuation means valuing an attribute of the company, right? Its current level of earnings or book value in terms of the price the market is ready to what to pay for that attribute. So you're just looking at the current level of earnings or the current book value of your business, and you are looking at it in terms of the price the market is prepared to pay for that attribute. So if you value your company, you can value your company, you can value your asset, you can value your liabilities, and let's say the total valuation of net valuation, right? Net valuation, that's your total asset less your liabilities. Let's say it's 50,000. Let's say um it's $50,000, right? But that will not stop there. How does the market perceive you? That's what matters. Does the market perceive you as 50,000? Funny enough, the market may perceive you as less, the market may perceive you as more, depending on what the market is seeing based on numbers and metrics, right? So when you look at that, if the market is valuing you less than what you think you are, then I don't think you have an edge to negotiate than what the market is saying, because the market rules, so you don't have control over that. But if the market is saying, "Oh, we've done your valuation and we feel you are more than this," then that's a plus for you. You've actually gained because if the market is saying that you are doing well, then who are you to say you are doing less? So we just go with that flow. So that's relative valuation. So you are looking at relative to what the market is saying. We also have cash flow valuations. So cash flow valuation is just showing identifying future cash flow. So we are going to look at the streams of cash flow in the future. That's where we make use of terminal value. Also, the possible cash flow to perpetuity. We discount it to present value, and we convert them to present value to get the core value of the business of what is actually what. So, and if you look at it, most companies they make use of what of the cash flow valuation. Where we have the DCF, discounted cash flow technique, and the likes. So mostly everything is done based on cash flow valuation. Even your dividend valuation model, streams of dividend you're going to receive. When we're valuing shares, we use dividend valuation method to value the share price of a business. So the future streams of dividend that you're going to make, you value it down to present value. So those are cash flow valuation. So in these three valuation method I've mentioned, I said asset valuation, relative valuation, and cash flow valuation is usually the most important. I won't
Right.
say it's the most important, but what
Sorry.
the okay.
The second one, what's relative valuation?
So relative valuation is when you value an attribute of the company in terms of the price the market is prepared to pay. So I already said that like you might value your company now based on your own internal valuation. You will now compare it to what the market perceives you to what.
I'm sorry, can you give me a moment?
Okay, all right.
I'm sorry for that. Is relative valuation the same as PE?
Yeah, it's close. It's close to P. It's close to P, price to earning ratio,
So
and
we'll
the
say
price to book
it's
value multiples.
like price earning ratio
Yes,
valuation, because
yes.
in ACCA it's mostly the ACCA website is mostly net markets, that's net value, net asset value, market value, and that market value is the PE. But when you say relative, it's new. So,
And so
um,
in your price, in price to when we do, for instance, price to earning, we look at my market price divided by your earnings, right?
um,
Those are relative valuations. Those are relative valuations. Price to book value multiples too. You're looking at the market price to your book value, right, of your company. So those are examples of relative valuations.
okay, okay.
Yeah, those are examples of relative valuations. Yeah. So that's it. So this does how the method is. The method is called, we have asset valuation, we have relative valuation, and we have what? Cash flow valuation. So under assets, we have what it covers. That's just when you're saying your asset less your liabilities, right? While under relative valuations, we have the likes of price to earning ratios, we have the likes of price to book value ratios. And under your cash flow valuation, we have free cash flow to firm, free cash flow to equity. Does that answer your question?
Yes, it's fine. I just wanted to know because that relative was a new term.
Oh, okay.
I haven't heard about it before.
All right. Yeah, cheers.
Okay.
All right. So so let's start with, so we now move to the types, right? So we have net book value. When we talk about net book value is just our normal accounting equation, right? I would have used the board, but to work with you, but the board, we've tried it, I and the technician is giving us some issues and the likes. So that's why it's currently not available. But we're meant to use the board, to start using the board today. But I and the technician, we've been working on it for over 1 hour, and I don't know, he has to do some setup, and that is why I'm not displaying anything at the moment. So, but at least, yeah, so we can converse and discuss. So, so we have the so we have the net book value method, and like I said, it's just the what? It's just the balance sheet equation approach, which is where you have your equity is equals to your asset minus liability. It's just what we have on this on the face of your statement of financial position, where your total assets less your liabilities is what? Your equity. So, and when you get your equity is just the value of the company. And when we talk about equity, what makes up your equity?
I think reserve and shares. Shares and
Yeah, so basically your equity is just your share capital, your share premium, and all
does
your
does
what?
those long term liability do they make up the equity?
No, no, long-term liabilities don't make no, long-term liabilities. Long-term liabilities don't make up your equity. When we talk about long-term liabilities, your long-term liabilities are your long-term loans, your debentures and the likes. Sure, you get bonds. Those are long-term liabilities.
Okay.
Yeah. So when we talk about equity, equity is just your share capital, your share premium, and your what? And your reserves. Your reserve, which is also called your retained earnings and the likes. So
Okay.
yeah. So that's your equity, and that's actually the value of your company, basically, from a net book value perspective. So, but what are the problems and weakness of this method? It's based on historical cost, right? It's balance sheet values, your carrying amount, and they are usually what? They are historical costs rather than market value. And that does not reflect the true price of your value or the true worth of your company. Is what the market is saying. That's what should reflect the true price of a company. If you are carrying what is on your statement of financial position, that's just book value. That's historical, using historical cost to value your company, and that does not reflect the true worth of your company. So those are one of the problems and weakness of what of a net book value method. We also have the accounting policies. The accounting policies, net book value of non-current assets depend on depreciation and amortization. So different companies can have different accounting policies depending on the books, the banks, or the company's um, policy. For instance, now, if my depreciation policy is straight line method, right? And let's say we are even operating on the same level of fixed assets, this operating almost at the same level of operation. If my depreciation policy is straight line and your own is reducing balance, our valuation is going to be different, right?
Yes.
Because yeah,
Yes.
it's going to be different. So accounting policies might distort what the value of those companies when you're looking at it from a relative point
Yes.
of view. Yeah.
Yes. Yes.
So accounting policy, historical cost, unrecorded asset. There are some assets that you don't even record.
So is this the limitation of which model now? Is it the asset based model?
So yes, this under asset valuation, net book value,
No,
using the
I
net book.
am because I'm writing it just in case. So this point that you just said is the
Yeah,
limitation of the assets,
yeah,
right?
using the net book value. Yes, using the net book value approach.
Okay.
Yes.
Okay.
And net book value approach, I said equity is equals to assets minus liabilities.
Yeah, yeah.
Yeah. So I'm just talking about the problems and the weakness of this method. I talked about
Yes.
historical cost, right? I talked about accounting policies. We also have unrecorded assets. So there are sometimes that there are some even significant assets that you may not record in your statement of financial position. Sure, you understand? For instance, internal generated goodwill. You might not recognize those things. So most people don't even recognize internal generated goodwill. It's only goodwill that you do when you maybe buy a company, normal external goodwill. But the one you generated internally, most corporates, they don't value that. So and when you don't value that, you're understating your assets. So those are limitations of those are so I think that three is enough. You can go and read more on that. And
Okay.
and
Okay.
yeah. So so we say therefore a share valuation based on balance sheet net asset is unlikely to be suitable. So because of these limitations, you won't get the true worth of the value of a business. So let's move on. So we also have net realizable value. I don't know if have you heard of that net realizable value before?
So that's like the disposal value now, right?
Yes. So it's just when we want to get our equity is the estimated net realizable value of assets less liabilities, right? So the estimated net realizable value. At least this estimated net realizable value is still better. I would say it's still better. Why would I say that? Why do you think it's still better when we look at estimated net realizable value? Why do you think it's better than using a net book value approach? From well, just look at
For
it, just
me,
picture it.
I just you just want the company just wants to get the true nature of that asset that they intend to dispose, because it may not prompt a decision making criteria from them, because that asset that they want to dispose may even have higher realizable value, like higher market value than even the
Mhm.
one they want to retain.
Thank you very
Than
much.
even the what they want to retain. So it's kind of prompts a good decision, and it may now make them go back to the drawing board to reassess what they are trying to do.
Yeah, yeah. Thank you. So that you've actually said what I wanted to hear, right? The market realities, right? Like I said earlier, I said the beauty of valuation is how does the market perceive you? So when you're looking at it from a net reliable point of view, it reflects the market reality, right? Like, okay, if I go to the market, what does this thing worth in the market? And if I sell it, it shows that okay, yes, I've factored in what the market is actually saying concerning this asset. So for a net realizable value, its equity calculation is calculated by estimated net realizable value of assets less your liabilities, right? Estimated
Yeah,
net realizable value of assets less what? Less your liabilities. This is
liability.
different from net book value where equity is equal to asset minus liability. The asset is just the book value asset, not the what? Not the estimated net realizable value of assets. So that's the
Okay.
difference between net realizable um, value and net book value. But there's also limitations and problems with using the net realizable value. And one of these is what? You're estimating your sell price can be under what? Forced sale or distressed condition. Do you understand?
Okay. No, I don't
So
understand.
so when we say forced sale or distressed condition, if I want to sell my company by all costs, right? I can be selling due to distress or what or
Yes.
a forced sale. And when it comes to forced sale, a forced sale, when you sell something based on forced sale in a forced sale approach or in a forced sale condition, it does not shows the true value of the sale under ordinary course of business level. So for instance, now let's say this inventory, let's say normally, let's say if I go to the market, my inventory that I'm holding is currently worth 100 million naira. But let's say, for instance, it's under for sale. When I go and okay, it's 100 million because I'm desperate to sell, right? I might say, oh, let's bring 40 million. Do you understand?
Okay.
It's just for instance now, you have an asset, you have a laptop or you have a phone, and let's say, I want to pay for school fees. I want to pay for school fees, and let's say once I'm not you. Let's say Chizoma want to pay for school fees. She has a phone. She has a phone worth 100,000. Her school fees is what her school fees is let's say her school fees is 120,000 naira, and she goes to the market and she says, oh, I want to sell my phone. Oh, my phone is 100,000. Madam, I can't buy your phone for 100,000. No, I beg. I'll pay you 40,000 naira, and she has a deadline to pay school fees. What will she do? She has no choice but to sell that phone at that 40,000
Yes.
naira. Sure, you
Yes.
understand? That's under what? That's distress condition. That's a for sale agreement. She has no choice. It's not in the normal way. Let's say the sale of the phone is not conditioned on the payment of school fees. She might go to the market and say, I'm selling this for 100,000. If someone says I'm going to buy it 40,000, she's going to, well, it's not really I'm in need of the money like that, right? So when I get someone that wants to buy it for 100,000, then I will sell. But because she wants to what? She wants to pay for school fees. She has no choice but to say that, oh, let me just sell the phone for 40,000 naira. I will get the remaining 60,000 naira from elsewhere and settle off my school fees. So sometimes those are the weakness when it comes to what using the net realizable value of asset approach, right? Because why? You might be selling under what? Under forced sale or distress or condition. So another thing again is sometimes the market might be volatile, right? So there's some assets that have volatile market values. So especially commodities in financial instruments. The financial instrument is so fluid that you can go to the market now, dollar might be 1,005, and something might happen just between now and 30 minutes. It can be an economic decision. CBN might decide to increase NPR, might decide to go and maybe from the MPC meeting, just change the whole metrics. And the dollar that you bought 1.5 now, right, in next 30 minutes or in next 2 minutes, is already selling for 2,000 naira per
Yeah.
dollar. So there's a market that are highly volatile, especially when it comes to commodities like financial instruments, right? So those things, net realizable value might not be realistic to make use of. So that's that about net realizable value. So most times people don't really use it. In practice, people don't really they don't really use the net realizable value
Sorry, what did
approach.
you say? What did you say the commodity like? Which asset does it have? What kind of asset?
So I said financial instrument
Financial
like
instrument.
your futures, your forwards contract, and all those things, right?
Okay, okay,
Yeah.
okay.
So let's move on. So there's another one called replacement cost. So replacement cost is okay. What's the estimated replacement cost of net asset? To me, I feel net realizable value is still closer to replacement cost, because replacement cost it just shows, oh, okay, the maximum price a buyer might be prepared to pay. So maximum price, most times there's still a bit of market realities in it, because most times when buyers want to buy in them, when someone wants to pay, let's say for instance, if I want to sell something to you, what will you do? If I want to sell, let's say, an air conditioner or a phone to you, what will people do mostly? They will go and check the price on maybe like Gigi. I
Okay.
don't know if you might you might just go on the internet. There's Gigi. I don't know if you use Gigi a lot. Most people buy and sell things on Gigi. So someone might just say, oh, this phone, Samsung A50. Let me go to Gigi. What's Gigi saying? If Gigi is saying 40, 45, 50, within that range, Gigi will give you the range. Maybe it's between 40 to 50. That would form the basis of the price at which you as a buyer want to buy. So I still feel this estimated for me. Oh, I'm just saying for replacement cost, it's still close to realizable value for me. I don't know, but here we have it. But it's distinct, sha, from the book this thing. So they said replacement cost can be viewed as the cost of setting up an identical business from nothing. So it means that equity is what estimated replacement cost of net assets. So if I'm going to replace this net asset, what will it look like? I currently have this asset. Let's say I'm going to replace it. I'm going to replace it. This same thing, if I want to buy it in the market, I'm replacing it. At what amount will I buy it? Whatever amount a buyer is ready to buy it or a seller is ready to sell it, that will form the value of that asset I'm holding. Is that clear?
Yes, it is.
Yeah. All right. So what are the problems and weakness of this method? So they may not be comparable replacement assets. So let's say, for instance, now this is my phone that I'm using now. If I go to the market, can I replace it? If there's no replacement asset that I can use in valuing this phone, then the replacement cost approach is useless. So those are
Okay.
those are the limitations of that this thing. We also the limitation of overvaluation due to valuing old and less efficient assets at current market price of new asset. Let me say that again. Overvaluation due to valuing old and less efficient assets at current market price of new assets. So you might have done an overvaluation of what you are currently carrying of your old assets. By the time you go to market may surprise you. So that's part of the limitation of a replacement cost. Let's move forward. So we also have the book value plus approach. The book value approach, you can read that You can read that up. Let's move on. That one is usually not done in practice actually, but you can read that up. The book value plus approach. If you have issues on that, you can talk to me and we can discuss it better. So let's
Okay.
move on. So let's move on to if you notice most of those things I've talked about, they fall under the asset valuation. I gave you three broad this thing from the beginning: asset
Yes, yes,
valuation,
yes,
relative,
yes,
and yeah. So that those
yes,
ones I just spoke about, they are mostly under asset valuation.
yes,
So they're
yes.
basically under asset valuation method. So let's now go to the other part. Those relative. We have price to earning ratios.
Okay.
So and what is price to earning ratio? Takes into account the expected growth of that company. So it reflects the market expectation for the what? For the business. So I'm looking at what the market price of that business is and what and comparing it with my own what with my own position, right? That will give me a particular ratio and that will make me what value the company appropriately. Like currently in my company, I uh for a while I used to be the one valuing our quoted company. So for instance now we have some investment in my company. We have some investment in some unquoted companies. And when you have investment in unquoted company, if you buy the shares or if you buy a stake of a quoted company, it's easy to get the valuation of your own particular stake, right? Let's say for instance now I buy shares in Nestle. I buy 55 million, right? 55 million units. If I'm doing a valuation as of today, and the share price quoted, let's say Nestle is a quoted company, right? If the share
Okay.
price is 5 naira, what's my valuation? What's the value of my shares in that company based on what I've said?
Um, to be 5 times the number of shares.
Thank you very much. That's easy to get, right? That's just 5 times what times in units that I have, which is let's say 50 million, 5 times 50 million units. That's the total value of the shares. That's all.
Okay.
But let's say, for instance, let's say I invest in, let's say, for instance, Total Energy, right? And Total Energy is not quoted, right? How do you think I'm going to value it? I'm just asking you. This is just to create this thing. How do I value it? And it's not quoted. What can I do?
Maybe get a proxy company and use their information to assess yours.
Thank you very much. Yeah. So you just get a proxy company. You can get close to 8 proxy companies. And note that there are some criteria you use for those proxy companies. You must be operating in the same industry.
Yes.
Is good. That's the best way. Operate in the same industry, face the same
More
business risk, face the same similar business risk, right? And
more
also,
financial
whatever is
risk.
facing that industry is also what is affecting. So all of you are grouped together. Sometimes it's good to, let's say your investment is in Nigeria, and let's say the market Nigeria. It's good to value based on Nigerian realities than using
UK.
other like US
Um,
company. If you are using US company, you are not facing the same issue.
issue.
Government, but
Um, Hello? Someone. Hello? Hello? Hello?
apologies.
Hello?
Can you hear me? Yep.
You were
Can you
off. You were
hear
off
me,
for a
please?
while.
Oh, all right. Apologies. So where I stopped at where I said proxy companies. So for instance, a company in US or a company in UK would thrive better than a company in Nigeria, right? Based on the based on
So in this
how
case, we're using, sorry, in this case, we'll use both, even the economy, that the country that they are based, their business and
yeah, it's good.
financial needs.
Yeah, the business, they are facing the same business risks. They might not face the same financial risk, but the business risk is very important.
Second.
So it's good to use the same geographical location, not necessarily country per se, but the same geographical location. Let's say, for instance, now if you are doing some valuation, it's better to use some African countries. Sure, you understand? Let's say
Okay.
all of you are an African. Sure, you understand? It's better to use African companies. So most times like that. So when I do valuation of unquoted companies, I make use of what I make use of African countries. I look at the business risks and also be in choosing those companies, and I ensure that okay, they are operating in the same industry and the businesses are likely the same. Sure, you understand? So those are things, and you look at different range of companies, and you take a lot the average of. So for my company now, we make use of the price to book value multiple
Okay.
approach.
Okay.
Yeah, the price to book. Some companies make use of discounted cash flow. Some people use price to earning ratio. Like for Zenith, I think Zenith Bank makes use of DCF, discounted cash flow approach, right? That one is more.
I would have loved to see like a practical, not you disposing sensitive information, like how you do it practically.
How much will you pay me for that? Zee, if I show you practical.
It's for
Yeah,
the exam. It's for the exam now, because if you notice, this ACCA is more practical, because after
yeah,
doing the all this, you will still have to explain how you did it,
yes,
like
yes,
suggestion. And
yes,
so
yes.
that's what I'm saying from that angle. Like, I would love to see
Okay,
the practical how you do it, because even the
okay.
course
So
valuation itself is quite. It's one of the complex topic in
mhm.
ACCA.
Yeah, yeah, yeah. That's the call, because your understanding of business valuation will lead you to understanding mergers and acquisition and
Yeah,
reconstruction. Sure, you
exactly.
understand?
Exactly. As in,
So,
that
so,
business valuation alone, it can help me with that three. And that three course is a three different topic itself. Aside,
yeah.
yes, so it will help me with that, because that's where I'm having challenges. That business
Well,
valuation, measure and
oh, you have,
acquisition, and corporate
okay.
reconstruction, because I'm not really
Restructure
seeing practical. And
questions.
if I understand that practical this thing, maybe if you have your own one of the class you will have, I would love to see
Okay,
how you do
okay.
it practically.
Not a problem. Not a problem. I just pray time permits me. Though Emmanuel will be doing a lot. I just pray me to I'll be coming in between to support, because to be honest, this season for me is very, very busy. I won't lie to you. I just because we don't just have a choice. Yeah, I'm very, very busy. But let's see how things go. Let's see how things go. All right. So, so like I said, the price to earning ratio. So, like I said, it reflects what it shows the market realities of what of the market expectation for the business. And you know the formula for price to earning ratios now.
Yes, that's
So,
EPS over MPS.
nah. Don't go and make that mistake. Oh. It's not EPS or MPS. Oh.
Mm. I thought it's EPS over MPS.
Oh, it's not EPS or MPS. Oh. So for price to price to earning is what is your MPS market price divided by
Okay,
your
the
EPS.
reverse. Okay,
Yes.
all right.
So it's your NPS. Please don't
EPS
miss it.
over
Yes.
MPS over
So
EPS.
there's yes. So this is your price to earning ratio, and for you to get your price to earning ratio, so there are some questions they may give you. They can give sometimes they will give you the NPS, right? They'll give you the NPS. You have to calculate the EPS yourself from the question, and you still know the formula for EPS now.
Yes,
So it's just your profit. The profit after
profit
tax,
over.
profit for the year
over.
attributable to ordinary shareholders, right? Divided by your what? Number of issued ordinary shares. Please don't go and use PBITO. Please don't use PBITO. For you to use your APS, you must have taken the interest that is due to debt holders, right?
So it's PATM.
Yeah, so it's PATO. So that's why they say profit for the year attributable to ordinary shareholders. Are you usually free during the week?
Yes, I'm free during the week.
Okay. I just want to create my time for you. So I'm looking at how we can structure it where because we are far behind schedule and you want to write December, right?
Yeah, and by special grace. Yes.
Yeah, which is fine. I'm looking at a scenario where if um if Emmanuel can be covering if he can cover weekends part while I cover maybe midweek. let's say for instance, let's say in the evening, we does do like a 2-3 hours, sure you get.
Yes,
So
please.
as I'm bombarding you during the week, it's bombarding you on weekends. So we'll be able to cover more just to do that for you and so that ensure that you do well in your exam. Because I know that in the beginning, I only covered the surface level, so I didn't go deep. So we didn't solve comprehensive questions. But at least normally even in an AFM class, in the beginning classes, we just do more of just scratch the topic before we now go deep. But I just want to create, I hope and I'm trusting God to create more time so that we can do that. So if I can cover during the week, it covers weekend. At least you are good to go.
Okay.
All right.
Thank you.
Yeah. Yeah, you're welcome. So for EPS, so is profit what? For the year attributable. And profit for the year attributable is mostly your PAT because you would have taken interest that is due to what? To debt holders and and that. So like I said, sometimes they might give you MPS and they won't give you EPS. So you have to get the EPS yourself and get that. So and basically the reason why you are having all these things in valuation, the important thing in this thing is your market price. Oh. Hope you know. This is what we want to
Yes.
get. Because when it comes to merger and acquisition, this is what we're interested in, that MPS. So if they give you your PE, right? They may give you your PE, they may give you your APS. What you just need to calculate is your MPS. And you already have data. What are you doing? Is just what? Your price to earning ratio. Price to earning ratio multiplied by your EPS will give you
Yes.
your MPS. Sure you get. Are we clear?
Yes. Yes.
Yes. And even for math basis, you can see that price to earning. Price to earning is MP is equals to, they say MPS divided by what? EPS, right?
Yes.
Multiplied by, I'm just looking for APS divided by EPS. So this is it. This is the formula for this is the formula for this is the formula for MPS. So like terms, this is your EPS. EPS divided by EPS. It still boils down to your
I'm
MPS.
seeing I'm seeing NPS equals to MPS divided by EPS times
No, no, no,
APS.
no, 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 no. This is the MPS I mean. This is MPS. This is what I'm talking about.
Yeah,
This
please.
MPS here. Do you understand?
I
This
don't
MPS
understand the
here.
second one. I don't understand the
Hold
second
on.
one.
Hold on. You understand now. This MPS. You understand this first one, Abby?
Yes.
Thank you. You understand this first one. Now, I'm breaking this price to earning ratio for you. This price to earning ratio is this one I put here. This is equals to.
Yes.
Normally the
Yes.
formula for, you understand now?
Yes.
So this price to earning, the formula is MPS over EPS, right? Which is this
Yes.
guy.
Yes.
So if it's this guy, if you multiply it by your EPS, EPS cancel out in PS. MPS is equals to MPS. I'm talking about from a math perspective. That's why, yeah. So it's just normal mathematics. What I just did there is mathematics. So let's move on. So for your, have you done bond valuation, Macaulay duration? Have you gone through those things on personal reading?
Yes, I have.
Okay, so we don't need to touch that, right? You have an idea of what that is.
Yeah, I have an idea, but it may be different from what someone will teach me.
Okay, so let's see how things go during the week, or maybe next Saturday. All right, um, so let's move on. So we said MPS is equal to price to earning ratio multiplied by your APS. So
Hello? Hello, is someone there?
so
Hello, I wasn't hearing her at some point.
I'm trying to switch my network. I'm not.
Hello?
This particular one is, yeah. Can you hear me now?
Hello?
Yeah, can you hear me? Hello?
Yes, yes, I can hear you.
All right. All right. So let's move on. So I was trying to switch my network. The network I was using is cutting out, and I'm not comfortable with it. All right. So when we are doing this thing, so notes, and there's a note here. Profit for the year attributable to ordinary shareholders is profit for the year less any dividend paid to preference shareholders, right? That are treated as equity. So it's not only to debt holders. We also back out the ones that we share to what the profit that we allot to preference shareholders.
Okay,
You
so
get
it's PAT less dividends, all right?
yes, dividend, PAT less dividend, not dividend to ordinary shareholders, dividend to preference shareholders.
Preference
Do you
shareholders,
understand?
okay.
We have ordinary shareholders, we have preference shareholders, and preference shareholders, their dividend is fixed, right? Their own dividend is fixed. They are not
It's
residual
fixed.
holders.
Yeah.
Yes, they are. They are. Preference share is like a mixture of it has an element of equity and element of debt per se. Their
Mm,
own dividend is fixed. So if you are paying them 10 naira, it's 10 naira you are paying them. Whether you make money or you don't make money.
okay.
So you're doing when you're God.
The network is I can't hear you. Network
See,
is very
give me
bad.
1 minute. Let me work. Give me 2 minutes. Let me work on my network, please. Let me work on my network. Give me 2 minutes. Let me try to.
Hello, in case you are there online.
Yes, I'm here. I've been trying to reach.
I
I was
said
calling you.
I thought we were giving 5 minutes. That was what I thought now.
Yes, it was 5. We're already done with 5 minutes now, Abby.
Oh, okay.
Oh, you still need more 5 minutes?
No, no, no. You said I never thought I thought the 5 minutes was still running. But it's fine, you can go
No,
ahead. Sorry for the
we
delay. I had to do
no,
some
not a
things.
problem. Not a problem. Me too. I needed that short time
Okay, okay.
to check on something. All right, so let's move on. So I said so we're talking about the price to earning ratio, and so let's talk about the steps. So we have um the price to earning ratio can be used for valuing the shares in an unquoted company. And let me give you the step how it works, and that's even the practical step of it. For instance, you have the step one is select the price to earning ratio of a similar quoted company, right? It's just related to what I told you about my own company. We will make use of price to book value multiple approach. So some company make use price to earning ratios, some use price to book value multiples, right? So you select the price to earning ratios of a similar quoted company. And how do you get the price to earning ratios? You check. So you have you made use of capital IQ before?
No.
Capital IQ.
I'm
So
just
capital IQ is like,
saying
oh, you're just hearing capital IQ, right?
yes.
See all
Yes,
this thing,
yes.
you are just enjoying all this thing for free. Oh. All this
What I'm saying is that
this thing.
we didn't ask us this one in the exam.
No. They won't ask you all this one in the exam. It's just for your personal consumption.
Oh, okay, okay.
I'm just telling you for your personal consumption. What happens in practice is what I'm telling you.
Okay.
Yeah.
Okay.
So 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 capital IQ is what? It's like a app. Apologies, man.
Yeah.
So capital IQ is like a this thing, like an app where we check for prices of companies, right? All information, all metrics of a particular company, you can get it on capital IQ. You can get
Okay.
their ratios, you can get their data, their financial statements, their beta, their every financial information you need. Any financial
Okay.
information, you can get it. So for instance, so let's say for instance, I'm doing like a GT company. I can let's go to Capital IQ, all information on Capital IQ. I can get the market price, what is currently trading, what the traded last as of yesterday, what is trading as of this morning. Sure you understand? So from Capital IQ, I don't get the market price. When you get the market price, the earnings is what you have on the FS. Their earnings is on the FS, right? Their revenues on the FS. You pick that one, their most recent revenue, whether the last audited financial statement, and you just do what? Your market price divided by your earnings. You get the what? You get the price to earning ratio. If you are using a price to book value multiple approach, what do? You get the market price divided by the book value of the company. And when we talk about the book value of the company, the book value is just your equity, your total equity. And your total equity is, you will sit on the first two. That's your share capital plus all what? Plus your reserves. That's your equity. Or go through the long way of doing your total assets minus what? Minus your liabilities. When you get the price, the book value like that, your market price divided by your book value will give you your what? Your price to book value multiples. For price to earning ratio is price to earning ratio multiples. Sure, you get.
Yeah.
So when you get that, we now move to step two. Step two will now be adjust downward to reflect the perceived trading risks of an unquoted company and the non-what marketability of unquoted shares. Do you understand what that means?
Okay. No.
So when we talk about the perceived trading risks of an unquoted company and the non-marketability of quoted equity, or the non-marketability of quoted equity, what are we trying to say? What we're trying to say is this: if I hold, for instance, now, if I do it, if I hold, there's some shares, right? There's some shares that are unquoted. For instance, now let me give you an instance. Okay, I have let's say I work in Access Bank now, and I have investment in, let me look for a company that is not quoted. Let's say I have an investment in UPS, Unified Payment Service. I don't know if you've heard of UPS, Unified
Yes.
Payment. Yeah, let's say I have an investment in UPS. UPS is not quoted. So what do? I use the comparable company analysis, which is that relative valuation, under either using a price to earning or a price to book value multiples approach. If I price to book value ratio, if I get the if I get the price to book value of comparable companies that are quoted, which is that step one, what will I not do as a company? You know, even if I value UPS, don't forget that UPS, whether I use comparable company to get an estimate, the company is still not quoted, right?
Okay.
And if the company is still not quoted, my ability to sell my stake, my ability to sell my stake easily is very high. My inability to sell my stake is very high. When I mean my inability, it means that I cannot easily sell my stake, even if I get an estimate value of it. Because why? It's not quoted. So
Okay.
if an
I'm
if an
I'm still
investor,
trying to understand. I'm still trying to understand it.
okay, let me come again. Let me come again.
Mm.
Let me use an Excel. Can you see my screen?
Yes, I can see your screen.
Okay. So let's say for instance now, right? I come here. I want to value. I have investments in UPS. This Unified Payment System, right? I have 20,000 units. I'm just giving you an instance, right? There's no price for it because it's not quoted. So I have to estimate the price, right? I have comparable companies, proxy companies,
Yes.
proxy companies, and let's say their price to earning ratio. Their price to earning ratio upon computation is, let's say for instance, let's say these are the proxy companies. This is the price to earning ratios. Let's say I have a GT Bank. Let's say GT Bank own is 1.2, right? Let's say Echo Bank is 0.8. Let's say um, another company, CSCS, that is related to UPS is 1.3. If I'm
Yeah.
if I'm using a price to earning ratio approach, what will I do? For me to for me to value it, I will get I will get an average. Hope you know.
Yes.
you know, I'll get an average. So when I get an average, because it's average of these proxy companies I will use normally. So I will use average of these three. This will be my multiple. I'm not giving you this is that practical, the practical word of it. This is how we make use of it. This is how we do. This is the basic of the practical. This is a price to earnings multiples. We call it multiples, right? When you have this, what do you do? What you do is this. You get the book value. You get the book value of that company. The book value of that company.
So the book value is like the
That's the
asset
equity.
book
Yes,
or
that's
the
the equity value.
equity value. Okay.
Yes, that's the
Okay.
book value. The book value. You get the book value. The book value is your equity plus all your reserves. Sure, you understand? Is your equity plus all your reserves. Let's say it's 500,000. Let's just give it this, right? What will I do? For me to get my total equity value, of what, which is market value, right? Market
Hello.
value.
Hello. Hello.
Yeah, I can hear you. I can hear you.
Hello.
So
Hello.
if I'm going to, hello, can you hear me?
Yes, I can. It's breaking. Like
Yeah, I can hear you. Z.
it's breaking. It's breaking.
Okay. I think it should be fine now.
I think the internet is
I've changed to two.
okay.
Yeah,
Okay, I can
I've
hear
changed
you
to two
now.
different networks now.
Okay, I can
All
hear
right.
you.
So let's say I want to get it. So I've gotten the book value. This is my price to earning multiples, right? If I want to
Yes.
get the total market value, what do I need to do? I'll just multiply my multiples, multiply by the book value of that company, which is UPS book value, right? I multiply it. So this is total market value of UPS in the market. Do you understand?
Okay.
If you don't understand, I can come back
So that total
because I've
equity,
used comparable.
because
Okay,
if you use that formula like multiples times the book value, it's the
yeah.
same thing as the total equity value will not be like EPS, have you? Because EPS
No,
is
that's not APSO.
P, because EPS is PE times market value. Have you? Maybe I'm
No,
just based on this
it's
formula
it's
you
it's the you've forgotten what we said. See what we said here. MPS you are talking about, not EPSO.
uh,
PE is MPS divided by EPS. MPS is equals to PE times EPS.
but if you now change the please go
Okay.
on. Please go on.
No, talk.
Because
Express yourself. Oh.
the thing is that I'm thinking that if you now change the subject of the formula, EPS is will now be like, will it be PE over MPS or PE times MPS?
Share for EPS.
Yes, like if you use the formula
Your
that
EPS, your EPS formula
no,
is
what I'm saying now, in some cases, they, in a
mm,
question, they might remove
mm,
one
mm.
variables. Like
Yeah,
they will
yeah.
just give you PE and MPS in the question. And you
Mm-hmm.
may want to know your EPS. Can you use this as like a subject of the formula thing and kind of use EPS as
Yes,
the
now
subject?
your EPS is your MPS divided by your price to earning ratio now.
First learning. That was what I wanted to ask. Yes, yes.
Yes, now
Now I
because
get
EPS
it.
this EPS MPS, right, divided by P, right,
Yes.
divided by P. Let me put it this way. I believe you understand what I mean. You know, you see the same thing as saying MPS times E, and you know your price to earning is what? Times EPS over MPS. MPS cancel as MPS. You get your EPS from mathematics
Mm.
view.
Yes.
So this is how we get. So when you now get your total market valuation, right? Just be following me. Your total market valuation. This is your total market value equity. Total market equity value. You have this.
Okay.
I told you in that step 2. There's something we say in that step. If you go back to if you were jotting, I said adjust downward to reflect the perceived trading risk of an unquoted company and the non-marketability of unquoted share. When we talk about non-marketability of a quoted shares, what we are trying to look for is the illiquidity discounts. That's what we're saying. Illiquidity discount. And when we talk about illiquidity discount is also showing that because these shares, don't forget that these UPS that have estimated, you know that this thing I've estimated, right? This thing I've estimated using proxy companies. You know the business is still unquoted. You can't see it in the market. Hope you know.
Yes. Yes.
So if you can't see it in the market, if an investor wants to buy, you know, it's not easy for me to buy easily. It's not easy for me to sell. What I mean is not easy for me to sell. Something that is quoted on the stock exchange, it can be easily bought and sold easily. I can just wake up this morning, go to my app and sell my shares now for quoted companies. Share you get. But for if I invest in an unquoted company, I cannot easily sell like that. I can't wake up in the morning and say I'm selling. We have to do valuation the way we've done this valuation. Now look for an investor that will also do his own valuation. Look at other businesses related. Oh, is this price making sense? Before we now agree at a what? At a position. That can take months, that can take even years sometimes. And the probability that the person will still even end up buying himself is very slim. Hope you know. The person can
Yes.
wake up and say it's not buying again. So what do we now do when we have businesses, when we have unquoted valuation? There's something we call illiquidity discount that we apply, meaning that the investment is not highly liquid. We cannot easily sell it. We cannot easily transform it to cash. So we appropriate an illiquidity discount. And what do we do with an illiquidity discount? It's just to reduce the value of that investment. So let's say this market value now is 550. I can now apply an illiquidity discount. An illiquidity discount means that I'm using it to minus my investment. Let's say, for instance, my liquidity discount, let's say my liquidity discount is 10%. Mostly, if you go and read Damodrans, go and read online, illiquidity discounts usually vary between 18%. You can check it online. Illiquidity discount usually vary between 18% and 20 something percent. But some companies, depending on what you want to use, 18. Let's just use 18. Let's just use 18. So I make use of 18. If I make use of 18, what will not be the new value of the investment? The new value of the new value will not be new value will be this multiplied by 1 minus 18%. Can you see? Can you see that the value has reduced?
Okay.
The value has reduced because why? This unquoted business, I cannot easily transform into cash, right? So I appropriate a what? An illiquidity discount to show that okay, I'm at People's mercy, so that I'm just giving a fair price, right? Just to show that okay, I've adjusted for that risk element that I may not be able to sell. Sometimes if you have a premium, there's something we call control premium. A premium means that I mentioned something on minority shareholding and majority shareholding earlier, right? And I said majority shareholding. For someone that has a majority shareholding, means that you have the ability to to influence whatever happens in that business. It means that when we're selling that investment, we usually include a premium that will show a higher valuation price. If a company, let's say this company, right, I have control premium. I can have control premium. Let's say for my valuation, my control premium is 10%. I just want to show you how control premium works. It's 10%. It's 10%. What will I do? This is what I would have done. Let's say I had a control premium of 10%. I would have done plus, because control premium gives me a higher valuation, right? It means that I have more value. The business has more value
More
because I have
value.
control. If you are buying, yeah, sure, you understand. If you are buying from me, I'm going to sell my premium to you too. Sure, you understand.
Yes.
So I will add this. And you see that the business has increased.
Yes.
So that's how we do valuation in practice. And that's just by the way. So let's move on. So that's what I was trying to explain in that step 2. Adjust downward. That downward was that illiquidity discount that we used in reducing that value. Adjust downward to reflect the passive trading risks associated with an unquoted company and the non-marketability of unquoted company, because they are not easily marketable, because why? They are not quoted. So it's hard to see fast buyer for them compared to a quoted company that you can just open your, if you are using a GT app or this, you just say, do you want to sell your shares? Oh, I need money ASAP. I can quickly share 2,000 units and share before the end of the day or by tomorrow. Someone has credited me, because why? There's a standardized market. Let me put it that way. The way you have futures market. I know you've done futures with Emmanuel.
Yeah.
Uh-huh. So I see unquoted as forward. It's not standardized. It's over the counter. So let's continue. So step 3, determine the maintainable earnings for the unquoted company's EPS. Determine the maintainable earnings for the unquoted company EPS. And step 4, we have multiply the earnings determined in step 3 by the adjusted P from step 2
Sorry.
to find the
So
value of the unquoted.
can I see this step? So I can write it.
Okay, all right. Um okay, let me see. Hold on, please. Let me get it out. So I've dropped it on the chat for you.
Oh, okay. Okay.
Yeah,
I'll check it.
all
I'm
right.
checking.
So what they just said, if you follow that step, is just what I've told you. The reason, so for this one, so don't forget, it's price to earning we are dealing with, right?
Yes.
It's price to earning. So if it's price to earning, you won't make use of book value. Apologies. You make use of your maintainable earnings. The example I was trying to strike here was, I was using price to book value multiple approach for you. But for when you're using price to earning approach, you use your maintainable earnings, right? It's still the same approach. For price to book value, you use book value. For price to earning, you use maintainable earnings, which is, let's say, is this still 500,000. You understand? So if you follow the step, you will see in that step 2, we've done that step 2. That step 2 is what I did here. By that step 2 was this place, factoring this 18%, right, of illiquidity discount. Step 3, they say determine the maintainable earnings, is this guy, which is this maintainable earnings here. This step 3 that they put here for you. This step 3,
Sorry, can I
maintainable
ask a
earnings.
question?
Okay, I'm with you.
What's maintainable in net assets?
Most times, maintainable earnings is just, for maintainable earnings, for maintainable earnings is just is your revenue. That's your earnings. Your revenue, your earnings is your revenue. Your earnings is your revenue. So
Did
maybe
you
if
drop it on the chart? I can't find it on the chart.
ah which
Is
chart
it
are you
on the
checking? No, is it
group chat?
this Teams chart I'm talking about? Oh,
Oh, I thought it was WhatsApp.
no, it's not WhatsApp. I dropped it on the Teams. It's Teams.
Okay.
Check. Have you just check the message on Teams?
Yes, sorry.
Uh-huh.
You were saying something in the exam.
Okay.
How would they like differentiate maintainable earnings from the normal earnings?
So to be honest, in exam,
Mm,
it won't
mm.
stress you with all these things I'm giving you. I'm just giving you for your own personal. If you know, you were
Okay.
telling me that you want to understand how we do it in practice, right?
Yes, yes.
This is just how we do it in practice. But in the exam, they won't stress you like this. That's just the truth.
Yeah. Yeah, first of all,
In the exam, they will,
give me exam on first. Then that's
for exam,
practical. We'll do it later.
for exam, this is what they will just do. If they say you should calculate your NPS in exam, right? What they will do for you is, you are trying to get market value, right? Do you understand?
Yes.
What they will just do for you is they will give you in exam, they will give you your price to earning ratio multiples. They'll just give you the multiple. Let's say it's 0.5. This is what they will do for you. Your EPS, they may say you should calculate your EPS, which is straightforward. Let's say your EPS turn out to be 5 naira, right? What you just need to do from an advanced financial management student is this. NPS is equals to what? Your 0.5 times, this is just an illustration. This is your market price per share. And let's say you have the value you have. Maybe you want to buy 200,000 units, right? What will now be the market value? Your market value will be 2.5 times 200,000. This is the market value valuation from a price perspective. For exam purpose, do you get?
Yes.
This is just exam. What I'm giving you is practical, how we do it in real world for valuing unquoted companies.
Okay.
Sure, you
Okay.
understand? I'm just giving you for your own, you can read up and you can work with that. So let's move on. So see what they said now. They said price to earning ratio of a small quoted company will be on average 50% lower than that of a comparable quoted company in the same industry, right? That generally, the higher the risks, the greater what the discount. That's what I was telling you. The higher the risks, the greater the discount. Meaning that, I said something, we are at your mercy. So because the company is unquoted, right, and the risk is very high. When for an unquoted company, there are no stringent rules applied to them. You cannot trust their books. They may even do a wrong valuation for you. Hope you know. The valuation is not 100% correct. So you cannot trust it. So you as a seller, you as a buyer, if you want to buy from that, you prefer to buy because of the risks inherent in it. You prefer to buy it at a discount. Meaning that, let's say if a quoted company is trading at 15 naira, if I come and buy an unquoted company, for me that have knowledge of how financial management work, if they are telling me quoted business, right, this unquoted value is also 15 naira, I will say never. If quoted is 50, then you have to give me a discount. The liquidity discount that you have to factor in the non-marketability of your security. If I buy your security, I may not be able to sell it in the future. So why would I want to buy your security? So you have to give me something at the discount. So instead of buying 50, I will price you to 20 naira per shares. Do you understand?
Yes.
So that's how it works. So let's now look at the problem and weakness of this method. We have proxy. A suitable proxy may not exist. Now, we've said all this grammar. I'm using GT, I'm using Echo, I'm using this thing. If I don't see a company that is in that industry facing the same business risks for UPS, how will I not do the valuation? It's going to be a problem. I may not be able to value UPS because there's no comparable quoted companies in that are facing the same business risks or the same industry or sector that I can make use of. So it will be a problem. And also we have issues like earnings manipulation. I was telling you, I said something on for unquoted company. Their books I cannot validate it because why it's not quoted. So I don't know what they've done. They can do a lot. They can do a lot of jingoism to retrieve their earnings. So that means, and when you manipulate your earnings, automatically what the valuation is not correct because you can
Yes.
decide to put a higher earnings for yourself, and if you put a higher earnings, if you put a higher earnings, the valuation will go up. So that means it's wrong. So your historical data too, and this thing, another so factor. So just have this three in mind: your proxy, earnings manipulation, and historical data. Price to earning ratio is based on historical earnings because why you are making use of the earnings in your company is what you've made over time in the company. That's your maintainable earnings. So you are still making use of what of historical data. So historical data, the risks in using historical data. So let's move on. So that's that about price to earning ratio. I think I've dealt extensively on that because you will see it a lot in the exam. Price to earning ratio. Normally, this class was supposed to be 5, but it seems I have strength to go further. Should we move on?
Yes, good.
This was supposed to be an introductory class. While Emmanuel will continue. Okay, so there are other ways in which you can do valuation. We have earnings yield. Earnings yield is not usually used most times. For earnings yield and the normal ratio that we do for investors and this thing. Earnings yield. Earnings yield is your EPS. Your EPS divided by your NPS. That's earnings yield.
Okay.
So some people make use of earnings yield to do valuations, though they said earnings yield is simply the reciprocal of the what of the price to earning ratio. So it's just like the reciprocal of the what of the price to earning ratio. So you can make use of earnings yield. Though I've not seen it happen in I've not really seen it happen in practice. I've not really used it, but some people use earnings yield. It's not really common. It's not common like that. So, but just have it at the back of your mind. So people make use of dividend yield too. So mostly all those investors ratio that we did in financial reporting, share you get, people make use of it to what? To value company. So we also have dividend yield. You can use dividend yield, and don't forget the formula for dividend yield. Your dividend per share divided your market per share, right? And so there's some questions now. Let's say, for instance, now you come across a question where they give you dividend per share and they give you dividend yield. If they don't give you, let's do it this way. We said NPS, right? The formula for NPS is your price to earning ratio and your APS multiplied by your APS, right? This one, right? For you to calculate your NPS, you must have these two data.
Yes.
Let's say, for instance, they don't give you these two data and they give you DPS and dividend yield. Sometimes
Okay.
they can be fun.
Okay, and they give us DPS and dividend yield.
They give you this. Oh, I can my share price. My share NPS is still the same thing as dividend yield.
Okay.
Hope you know. You can read out
You
of
said
this. I
your
know it's the
share.
normal thing we did in
Sorry, you said your share price is same as what?
your share price.
Network is breaking.
Your share price,
Uh,
which is no, is it my side? I mean, I can hear you clearly. My own is, and
no,
you cannot blame your own network now. Your own network will be perfect.
I, I,
my own, my own,
I
my own,
can't
my own,
hear you.
my own is fine. Yeah, but can you hear
Okay.
me now?
Yes, I can hear you.
I went for this thing. What we did in reporting, dividend yield. The formula is DPS divided by NPS,
Yes, okay.
market price per share, right? If you now do
Mm.
mathematics, taking NPS as subject of formula, NPS, your NPS will be dividend yield. It's meant to be dividend. Are we clear? Hello, Z.
It's actually breaking.
But me, I'm funny enough. I'm fine here. It's not breaking here. That's why I'm
No,
shocked.
I mean, I can't. From your side is breaking. It's stretching.
Okay, what about now? Is it fine now?
Yeah, it comes and go, but it's okay. You can go ahead.
Okay, please just let's manage this. So, but do you get the idea of this dividend yield is your dividend per share divided by your market price per share? So if we take subject of formula, your NPS will now be your dividend per share divided by your dividend yield. You got this
Dividend
part,
yield.
right?
Yes, I
So,
did.
so what I was just trying to say is that, let's say, for instance, they didn't give you this to calculate your NPS. You can also calculate your NPS using DPS divided by dividend yield. That's what I'm just saying.
Yes, sir.
So I'm just giving you another way to calculate your NPS. Should, in case, you know, in this, in financial management, is the data they give you that you make use of. So you can't be static with your approach. That's why this course is called Advanced Financial Management. You might be used to calculating NPS as your price to earning ratio multiplied by your earnings per share. And the examiner might decide to shock you. I might not give you a price or any ratio or anything related to this data at all. I decide to give you something related to this data. So for a smart student, you will know that NPS is calculated as price to earning ratio multiplied by APS. I can also use from a dividend perspective. I can use dividend per share divided by my dividend yield. I'm still going to get my NPS. You can go and prove that later.
Okay.
By
Okay.
breaking it down further. Yes. All right. So that one to also have a step. I will just put the step here for you. For dividend yield, when you are using dividend yield, it has its own step. I'll put it, I will drop it. I'll send it to you. So I'll drop it on the chat. So let's move on. Um, so have you heard of Tobin's Q? Hmm?
No, I haven't. I haven't.
Okay. So it's just a, though they won't test you on Tobin's Q. They won't test you on Tobin's Q. But let me just talk about Tobin's Q. Let me just quickly talk about Tobin's Q. So when we say Tobin's Q, hold on please. So when we talk about Tobin's Q is just expressing the relationship between your market value and the intrinsic value. We're expressing the relationship between what the market value and intrinsic value. And when we talk about intrinsic value, your intrinsic value is just what you calculate. Like for instance, your replacement cost. The replacement cost of an asset is an example of your intrinsic value. So let's say, okay, the amount at which I can replace this asset, that's my what? That's my replacement cost. Replacement cost does not necessarily means the market value of that asset. Hope you know. Hope you know.
Mm. No.
Replacement cost does not actually mean what the market is saying about, because if I want to replace an asset, the asset I'm currently using, it might not be actually the market price I will use. It can be negotiated price or anything or any available information to give a value to that asset. So your replacement cost does not necessarily mean the market price of that particular asset. It's just like saying I buy an iPhone now. An iPhone, I can buy iPhone at black market. I can buy iPhone that someone has already used, right, for 500,000 and buy a brand new iPhone for 1 million naira. The 1 million naira iPhone I bought, that's the real market value of a brand new, right? But
Wait.
I can buy hand to hand for 550. Does that actually reflect the true market value of that asset? No. Sure, you understand. So replacement cost, what I'm just trying to say that your replacement might not necessarily mean the market value of that asset. So when we talk about intrinsic value is just close to what your replacement cost. And what's Tominski trying to say? Tominski is trying to explain the relationship between the market value and the intrinsic value, and usually calculated as total market capitalization divided by market replacement cost of assets. You want to talk about Q? Q is saying your total market capitalization, total market capitalization divided by what? Replacement costs of assets. And when we have your Q, what are we saying? So for instance, let's say your total market capitalization is 250, for instance, right? 250. And your replacement cost is 200. It means that your Q ratio is what? Is
My what?
1.25.
So what does this
Your Q.
1.25? What does it represent? Does it represent the market price per share?
No, Dobinsky is not talking about market price per share or anything.
So what does it represent? Like how will I use it in an exam?
Like I said, this one is not usually tested, but it's part of the syllabus for you to know, right? It won't come out in your exam. It's just, let's say you end up you work in a corporate finance firm or a valuation company. It's for your own personal. Most of everything I'm telling you is in the ACCA syllabus, right? But it's not everything you're going to use in an ACCA examination. Do you get?
Okay.
But for this level, do you need it? Yes, you need it, because the beauty of this level is not for you to just read and pass. It's in your syllabus. This what I'm telling you is in your syllabus. That's what makes you distinct. We're not here for advanced financial management to just read and pass. It's for what we can after this exam. What are we going to hold, especially in companies or especially in any institution we find ourselves? That's what makes you distinct. How smart you are, how vast you are. It's not just to read and pass AFM, right? That's the beauty of the essence of advanced financial management course examination. So it's part of your syllabus. You might want me to restrict this training to what is only useful for exam, but I will not advise you. You need to know all these things. If someone actually wants to be in queue and you're saying, I don't know it, you are ACCA chartered.
Okay.
Sure, you get. So when we say, so what do people, why is this needed? To be queue is not, to be queue is just needed to aid investors, invest an investor's perception of your business. So I can decide to, I got this 1.25 now, right? If the market capitalization is 250 and the replacement cost of the asset is 200, it's just 250 divided by 200 is your to be in queue, right? To be queue is just showing your relationship between the market value and intrinsic value. And if you're, so let me tell you the beauty of what to be queued to be queued does. For instance, it can be adverse. Let's say your total market capitalization is 200 and your replacement cost of assets is 250, right? It means that your to be Q ratio is what? Is 0.8. Are you following? Normally, to be Q is supposed to be represented as 1, meaning that normally for normal business as usual, your market capitalization divided by your replacement cost should be 1, meaning that what your market value is should also be the same as your replacement cost. And that's what I was explaining to you of an iPhone. Do you remember that analysis?
Yes.
Right. Now, then I said, the long run equilibrium for a to be Q ratio is 1. A company with a ratio of less than 1 is more vulnerable to acquisition, as this suggests it can be acquired more cheaply than the acquiring what underlying assets. What are they trying to say? It means that if me as a valuer, I come now and I notice that your to be Q, your to be Q's ratio is less than 1. It means that the market value of your business is less than the replacement cost of those assets. What are we trying to say? What we're trying to say is that it means that I would rather buy you cheaper than buy a replacement. I don't know if you
Replacement.
understand. You
Yes, I know. So if
let's
it's
say for
less
instance now
than,
this
if
thank you.
no, you can say
If
something. You
it's
said
less than
if
1,
it's
okay.
okay.
No, talk, please.
You said if it's
Express
less,
yourself.
like if the Toby Q is less than 1, so it's better
Mhm.
to retain the business than buying a replacement of the asset.
So from a seller's perspective, you are right. But from a buyer's perspective, if me I'm an investor, if I calculate your business, this business, and the to be Q ratio is less than 1, as a buyer, will I want to buy? Let's start with that. Let me see if you understand it from that perspective.
No.
Why? Why do you think I would not want to buy?
Okay, from a buyer's perspective, it's really quite complicated.
Mm-hmm.
I think you should buy it because
Why should I buy it for me?
it means the business is overvalued.
From a buyer's perspective, will I want to buy a business that is overvalued?
Sorry. Yes, now, if a business is overvalued and you are paying less, you want to buy it now, right?
No, no. If a business is valued, I won't pay less. Don't forget valuation. If the business if I want to buy a business, right? I think I understand where you're coming from, but don't see it from this perspective. If a business is overvalued, I won't buy it now. What's the joy of buying an overvalued business?
No,
If this
sorry.
business,
I was talking
the
about
minute,
undervalued. Yeah. Like
thank you. That's why I know that's why I feel you're using the word.
it's undervalued, not
So
overvalued.
it
That's
means that the value. Thank you. That's the word I was expecting. So atomic Q's ratio of less than one means that the business is undervalued. So it's a potential. People want to rush it because if
yeah.
the market capitalization is lesser than the replacement cost of that asset, it means that the business is undervalued.
Yes. So if the market, oh, yes, yes, yes,
Thank
yes,
you, thank you, thank you. We're on the same page now. So like I said, we use it for what for knowing whether to invest in a company or not. So I said it here. Let me now repeat what I said again. A company with a ratio of less than one, right? It can be 0.8 or whichever thing, is more it's more vulnerable to acquisition, as this suggests that it can be acquired more cheaply because it's undervalued. So you buy it at a cheaper rate. So I
yes,
want to buy
yes,
it now as an investor. Do you get? Uh-huh.
yes,
So
yes, yes,
so a company with a ratio greater than one indicates overvalued company earnings earning a rate higher than its replacement cost. Individual or other companies will create similar types of business to capture some profits. Let's leave that by the way. But what we're just trying to say is that it just shows about valuation. Means that if it's greater than one from a Tobin Q's perspective, it means that the business is overvalued. And if it's overvalued, we as an investor, we can tell you
it's
that
not
no,
attractive.
this
Yeah,
it's
yes.
too what is this? It's not attractive. Yeah, the value is too
Yeah.
high. Let's reach an equilibrium. Let's
Okay.
so if you find yourself working in a valuation company, these are things that will make you sell out. All right, so let's move on. There was one time I was trying this just for personal consumption. I was trying to enter. I was very interested in corporate finance, valuation, and all those things. So I was trying to enter into like a top one of the top audit firms, right?
Mhm.
To work in their corporate finance. I had done all their interviews, done all the tests, done all everything. That even they want to accept me, but you know now, audit firm they don't like paying well. It was the
No, if it's
it
those
was
big
the
fours, it's what
it
if
was
it's
the
those big fours, they pay well now.
yeah.
Sure, it's
Uh,
those big
maybe
fours. Is it not the big fours?
yeah, it's one of the big fours, one of the
But they
highest
pay
paying big
well
four
now.
self.
They pay well now.
They pay well, but where I'm coming from, where I'm coming from, what I'm earning is more than what they were offering me.
Okay, okay. Because of your experience.
Can you
Okay.
understand where I'm coming from? Yeah, yeah. Where I'm coming from, I get more from what
From what you okay. Okay. Makes sense.
do. That's not money now. That's not you think all these firms pay you, they pay well. They don't really pay well. Don't think they pay well. You can go to other firms, you will see correct money. Let's move on.
Because
That's by the side.
in
Did I
when I
record
was
that?
okay, you can continue.
What did you
Because
say?
when I was in Nigeria, I started off
You say when you were
with
what?
one of them. When I was in the country, I started off with one of them before I relocated. So,
And you think they were paying you call that
no,
one?
maybe because it was on a graduate level and how it will make your CV looks,
Uh,
knowing that you work with.
uh,
So it's good
okay.
from
Yeah,
it's
yeah,
good it's
yeah,
good
yeah.
from a
Yeah, for
graduate.
graduates.
Yeah.
For the graduates, yes, thank you. Well, yes, for a graduate level is good, but from an experience point of view, is not.
Experience point of view, no, it doesn't make sense.
Yeah, yeah, no, yeah, it's good for a plan. And did you work in the corporate finance unit or which unit?
No, just audits. That's what I want.
Okay, okay, auditor. So it was the corporate finance I was looking at. So
Mm.
do more, go deep on that. But the pay discouraged me, Jerry. So let's move on. That's just to check the class. All right. So we also have the market to book ratio. Market to book one also market to book ratio. And that market to book ratio is the most popular. Is the most popular and useful in the relative valuation of companies within a particular industrial sector, and is indeed, like I said, the most popular with market analysts, right? And that's what I told you earlier, that in my own company, that's what we make use of. Market to book ratio, which is also called price to book value multiples approach. Price to book value ratio approach. It's just, it's even very simple, and it's clear, and it's sweet. It's sweet, it's clear, it's straightforward, and it's more realistic. What are you just trying to do? It's just close to your price to earning approach. That price to earning approach that I showed you here. It's just close to this. The only difference is just where you have this maintaining earnings, right? Maintaining earnings. What we make use of book value here. The book value. Let me see. Let me just show you. So, for instance, you have GT Bank financials. Well, you know this thing, and since you've worked in audit now. So why am I? There's no point now. You know book value now. Book value is just your total equity now, right?
Yes, I know.
Hello, Z, are you there?
Yeah, I'm here. Yes, I can hear you, but it's cracking from your end.
Giving up. So let's say for
It's
a
cracking. It's
GT,
cracking. Ah,
this one is taking time to open now. So let's just move on. So where you have, I was explaining that price earning when I did price earning. So in use is what we use your the market value of equity divided by the net book value of the firm. And when we talk about the market value of equity, the market valuation that you have on site, right? So practical demonstration, market capitalization of GT Bank. This thing I'm giving you is free of charge. No, nobody will give you all these things. Z, in normal. So if I come here now, I can decide to change
Are you
the
showing me
capitalization of
something?
GT.
Are you
What's this
showing me
showing?
something? Sorry, are you
Oh, you
showing me
can't see my
something?
screen?
I'm not saying anything.
Oh, let me share again. Wow. I thought you can see my screen. Let me share again.
Mm.
Let me. Can you see my screen now?
It's blank.
Still blank.
Yes.
This network. Hey, this network. What are we going to do now? Because I'm sharing.
No, it's fine. Have people sent you a message on the chat box?
Oh, you sent me.
On the chat box.
Okay,
Oh,
you'll be going off in 10 minutes, right?
yeah.
All right, so let's just round up. Let's just round up.
Okay.
I think this is even this last one too. So when we talk about market to book ratio, it's just what using your market value of equity divided by your net book value of the firm. So you get the price to book value multiples, and you apply it to the what to the book value of the company to get total market value, like the way we did to that price to earning ratio of that analysis I did for you in that price to earnings. That's the way we do price to market value. So people said like I said, it said it is therefore useful in the relative valuation of companies within a particular industry or sector, and is indeed popular with market analysis. So this is the most popular approach to valuing a company. So we have others. We have the ordinary shares. You can read that up. We have preference shares approach. That one is not mostly used. The one that we are supposed to touch. Maybe Emmanuel will continue on that. Emmanuel will continue on that if at all, or maybe during the week. If you can chat me up, if I'm free, we can continue.
Please,
Did, did,
can you please create time during the week so that we'll just
so
because
so
even
so so chat
the
chat
one
me.
you did, even the
Oh
investment appraisal you did, we've not really gone
yeah.
deeply and we've not solved questions. So Emmanuel has actually done well in that risk management aspect. But from your, I don't know if you can just there's a way you could during the week. to just help us so that we can pass the exam.
All right. Let's okay. So that I can just prompt me. Let's prompt me between. Let's work with. Let's plan with Wednesday and Thursday.
Okay. So
Yeah.
I will send a reminder on Tuesday, right?
Yes. Send a reminder on Tuesday. Let me see. I will try to create either Wednesday or for you. Just a 3 hours class. Let's see how we can work on that.
No, even if you don't have 3 hours, at least let's just do something so and tidy up the one you first did before we will now, because this business valuation is something that I want to take very, very important. It is linked to M&A and the corporate
Yeah. Yeah.
construction. So that's where
Yeah.
I'm really shaking. And you could
All
see
right.
from our interaction, you could see that I was not really getting some variables.
All right. But I don't know if this class was helpful to some extent to give a background.
So it was
All
just
right.
for at least I understand from the practical aspect and all. So maybe
All
on
right.
Tuesday I'll send you a reminder. I'll be
All right.
going off
So
now.
all right. Thank you very much. Have a wonderful
Thank
day.
you.
Yeah.
I'll no
All
no
right.
I will say thank you very much. You've
You're
actually done. Thank you very
welcome.
much. I'll
You're
I'll I'll
welcome.
send you a
Yeah.
reminder on Tuesday.
Prompt me. I think I hope to create more time more and just try to tidy up my own aspects so that we
Yes.
can you can be
So
balanced.
that
All
this
right.
business valuation will just do it very well. We
All right.
still have those the theoretical aspects, those narrative aspects like the equity, those Dutch auction, SPA, all those Islamic finance to do and all that.
Oh, that's true. That's true.
So there's a whole lot. And
No,
from your own
for
angle,
so so for all
and
those
we even
ones,
have APV, sef. We even have APV, adjusted present value. So
I,
it's
I might
just, but for that
I,
risk assess, that risk management, Emmanuel has really, really, really done well in that. So it's just from your own, and also this, most especially this business valuation. I really, really, in fact, from the free cash flow to and also solve questions like standardized ACCA question and how they got some values. If you could just do that,